Welcome back to Money Talks But Slowly. I'm Alex.
And I'm Sam. This is episode 4, the final episode of our Introduction to Personal Finance series.
I can't believe we already finished 4 episodes. We've learned so much together.
We really have. Episode 1 was taxes and banks, episode 2 was interest and credit, and episode 3 covered inflation and recessions.
And today, we're talking about 2 very exciting topics, investing and time.
This is how people really build wealth, right?
Exactly. Everything we learned in the first 3 episodes helps you understand investing better. They are all connected.
Perfect. And before we start, if you are enjoying this series, please take a moment to subscribe. It helps us continue making episodes for you.
Yes, and share this series with your friends who want to learn about money using simple, clear English.
Okay, Alex, let's start with the big question. What is investing?
In simple terms, investing is when you use your money to buy an asset that you hope will grow in value over time.
An asset? What's an asset?
Great question. An asset is anything you own that has value. It could be a house, a piece of art, or a small piece of a company.
Okay, so like owning a part of a company. You mean stocks, right?
Exactly. When you buy a stock, you become a part owner of a business. If the business does well and makes more money, the value of your stock can go up.
Right. So if I buy a stock in a big coffee company and they sell lots of coffee all over the world, my stock could be worth more.
That's the basic idea. But, and this is important, there is also risk. If the company does not do well, the value of your stock can go down.
Oh, right. The value isn't guaranteed. That sounds a little scary.
It can feel that way, which is why we have a very important word in investing, diversify.
Diversify. What does that mean?
It's the idea that you should not put all your eggs in one basket. Instead of buying stock in just that one coffee company, you could also buy stock in a technology company and a company that makes clothes.
Oh, I see. So if the coffee company has a bad year, maybe the technology company has a good year, and it helps to balance things out.
Precisely. And there's a simple way for beginners to do this automatically. It's called an index fund.
An index fund. Okay, that sounds a little complicated.
It sounds more complicated than it is. Imagine a big shopping basket that holds stocks from hundreds or even thousands of different companies. When you put money into an index fund, you are buying that whole basket. You automatically own a tiny piece of all those companies.
Wow, so it diversifies for you. That makes it much easier and less scary.
It is. It's a very popular way for people to start investing for their future.
So, index funds are a great way to start with stocks. But are stocks the only thing you can invest in? I feel like I've heard of other things.
That's a fantastic question, Sam. And you are right. Stocks are not the only option. It's important to know about different types of investments. A very common one, often considered safer than stocks, is called a bond.
A bond? Okay, that sounds serious. How does a bond work, and how do I know what's right for me?
The answer isn't that one is always better than the other. It's about a fundamental concept in finance, the trade-off between risk and reward. Think of it like a seesaw. On one side, you have bonds. They are generally considered much safer because you are lending money to a company or government. They have a legal obligation to pay you back. This safety is great, but it usually comes with lower potential returns. On the other side of the seesaw, you have stocks. With stocks, you're buying ownership. This is inherently riskier because if the company performs poorly, your stock value can go down. But this risk is balanced by a much higher potential for growth over the long term. Historically, stocks have provided much higher returns than bonds. Think of it this way. When you buy a stock, you're buying a piece of the company. When you buy a bond, you're lending money to the company or even to a government. In return, they promise to pay you back the original amount after a certain period, and along the way, they pay you regular interest payments.
So it's like a loan. That does sound safer because you know you're getting your money back plus interest.
You could say that. It's when you earn interest not just on your original money, but also on the interest you have already earned. Your money starts making its own money.
My money makes money for me. I like the sound of that. Is it always better to buy bonds then?
Is the million-dollar question, Sam. And the answer is deeply personal. It depends on something called your risk tolerance.
Risk tolerance. That makes sense. It's not just about the numbers. It's about how I feel about the possibility of losing money. So, how does someone figure out their own risk tolerance?
That's a great question. It's about self-reflection. You can ask yourself a few things. First, what are your financial goals and what is your time horizon? Are you saving for retirement in 30 years or for a down payment on a house in 5 years? The longer your time horizon, the more risk you can generally afford to take. Second, you need to think about your emotional response to market fluctuations. If the value of your investments dropped by 20%, would you be able to sleep at night or would you panic and sell everything? Being honest with yourself about this is crucial. Let me tell you a story to explain. We'll call it the story of two friends, Emma and John.
Okay, I'm listening.
Okay, Emma starts investing when she's 25 years old. She invests $100 every single month. She does this for 10 years until she's 35. After that, she stops and doesn't add any more money.
Okay, so she invests for 10 years and then just lets the money sit there.
Exactly. Now, her friend John waits to start. He begins investing when he's 35. He knows he's starting late, so he invests $200 every month. And he does this for 30 years, all the way until he's 65.
Wow, okay, so John invests double the amount for 3 times as long.
That's right. Now, my question is, who do you think has more money at age 65?
It has to be John, right? He invested so much more money.
That's what most people think. But the answer is Emma.
No way! How?
Because she started early. Her money had 40 years to grow and compound on itself. John's money only had 30 years. That extra decade of time for her money to work was more powerful than all the extra money John invested. Time was her superpower.
That is amazing. So the most important thing is just to start, even if it's with a small amount of money.
Exactly. It reminds me of another story. We can call him David. David always thought, I will start investing when I have a lot of money. So year after year, he waited.
I think many people feel that way.
Then a friend told him he could start with just $20. He realized that was the price of a few cups of coffee. So David finally started, just putting in a little bit of money every week.
Okay.
He didn't think it was much, but after many years, he looked at his account and was shocked. That small, consistent habit had grown into a surprisingly large amount of money. He learned he didn't need to be rich to start. He just needed to start.
So the lesson is start as early as you can, be consistent, and let time do the hard work for you.
You got it. That is the secret to building wealth slowly and steadily.
And with that, we've reached the end of our 4-episode introduction to personal finance. Let's review what we learned. Taxes, banks, interest, and credit scores.
Inflation and recessions.
And today, investing and time.
Diversify and use index funds.
I feel so much more confident about money now.
You should feel proud. Learning this is a huge step.
And you did it while practicing English.
Exactly. Important money vocabulary, real-life ideas, and simple explanations.
But wait, this is not the end of the podcast.
Right. It's only the end of this beginner series.
We built the foundation.
And now we can go deeper.
More topics are coming very soon.
Before we go, make sure you subscribe so you don't miss the next season.
And please share the podcast with someone who wants to understand money but feels nervous about difficult English.
And leave a comment telling us what topic you want to learn about next.
We read all of them, and they help us choose our future episodes.
Thank you for learning with us.
And thank you for trusting us.
Remember, your financial future starts today.
Small steps taken consistently.
I'm Alex.
And I'm Sam.
This is Money Talks, but slowly.
See you in the next episode.